Coming up, dividend season is upon us. The Australian share market tumbles the most in a week in 6 months, but oil prices at the highest so far this year. All the details next. Your daily 10-minute business and finance news wrap for this Friday, the 15th of March 2024. Later, Rhayna Bosch will speak with Craig James about the outlook for dividends. But first...
Now, Market Day on the SBS On The Money podcast.
The Australian share market tumbled at the open today, down as much as 1.5%, but steadily climbed to be down just 0.6%. So it could have been worse at 7,670. Still, the decline for the week of around 2.3% was the worst in 6 months. For more, I spoke with the Chief Investment Officer at Blackmore Capital, Marcus Bodgan. So, Marcus, last week the ASX 200 hit a record high, but we're now down around 2.5% since then. What's happened?
Well, there are three factors that are driving the market lower in the last several days. The primary reason is concern around sticky inflation. We've seen higher than expected consumer and producer inflation in the US. And that's delaying the expectation that rate cuts will occur in the US and the Australian markets. The second reason is that there's lingering concerns around the Chinese economy. And the third reason is that there've been some profit taking in the banks, which has had a remarkable couple of months.
I'll talk about the banks in more detail in a moment, but first of all, in a broader sense, does this pullback worry you? Could it be the start of something a bit more protracted? And what about markets around the world?
Well, markets can certainly fall back further. I mean, it's been a very modest pullback at this point in time. But global economies, particularly the US and the Australian economy, remain sound. And corporate profits from the most recent results seasons have been better than expected. So there's fundamentally strong foundations, both at an economic and a company level, that is supporting the markets. And so we believe that markets can move moderately higher through the course of this year.
You mentioned earlier global interest rates. I think next week we've got quite a large number of central banks around the world meeting, including the US, the Australian Central Bank, the Japanese Central Bank, the Bank of England as well. I guess the most important one would be, in terms of the markets, the US. What's the market thinking will happen there? And then again, we've still got Australian interest rates too.
Well, it's very clear that since the beginning of this year, there has been a significant moderation in the expectation of rate cuts for the US, for the Australian markets, and globally. And that's been based on the fact that inflation continues to be sticky, both at consumer and producer levels. And the economy and corporate earnings have remained sound. And so that's delaying the impact of rate cuts. And so we've moved from thinking about 5 to 6 rate cuts in the US at the beginning of this year to maybe 3 or 4, and not starting in March, but probably starting in July.
What's your take on the banks? As you mentioned, share prices in those banks have been down over the past week. The Commonwealth Bank, most notable, it was at a record high last week too. Is it connected to this interest rate view?
Modestly, I think what has happened with the banks is that the results were much better than feared in the most recent results that we've seen in the last month. The economy continues to be sound. There seems to be very little mortgage stress in the major banks, but that has pushed valuations up to 30-year highs, and I think that's difficult to justify given the growth prospects of the banks are very, very modest. So I see this as a very healthy pullback in the bank share prices.
Turning our attention briefly to the market today, what's leading the losses?
The losses have been led by the resources companies on concerns around China growth. Technology shares have also come back, and they've been very, very strong. And the banks also have led the market lower today.
On the flip side, oil is at its highest point so far this year. It's leading to the energy sector being pretty much the only bright spot on the market this afternoon. What's behind that higher oil price?
Well, a report from the International Energy Agency suggests that oil markets remain tighter than originally anticipated. There are supply constraints, particularly from OPEC, and there is expectation that OPEC will continue to be very tight in terms of their supply for the remainder of this year. And demand has been better. So demand higher, constraints on supply has led to a higher oil price and leading to a 4-month high.
An interesting story that developed or came out yesterday afternoon, and we're seeing the implications on shares today. That's the growing scrutiny CEOs are facing at the moment, namely Tabcorp, shares in the company taking a hit. Its CEO quit on allegations he used inappropriate and offensive language. What does this say about the way corporate Australia is trying to navigate these types of issues and still meet shareholder demands at the same time?
Well, it clearly illustrates that good corporate governance cannot be removed from shareholder returns. So there is a social license required by corporates and particularly by their senior executives. And so I think this is consistent on what we're seeing there of the lack of tolerance for behaviour which is inappropriate.
And finally, where do you see the opportunities for investors at the moment?
Certainly from the results season, those companies that are exhibiting above average earnings growth that are in sectors which have got really strong long-term thematics. And they're sectors like logistics and data centres, and that's well represented in companies like Goodman Group, the healthcare sector, and technology companies which are offering digital and software packages throughout the globe. All of those sectors are offering above average returns. And the other area I would point to is an area which has been sold off, and that's the resources sector, which remains critically important for the energy transition.
That's Marcus Bodgan there from Blackmore Capital. From the markets, let's go to dividends, because over the next 5 weeks, around $30 billion worth of dividends will be paid out. Most of it during the week ending March the 29th, but it's less than last year. So for more on the future of dividends, Rhayna Bosch spoke with Craig James, CommSec's chief economist.
Are you expecting more people to take their dividends as payouts rather than reinvesting them?
I think there's going to be greater thought about taking it out as cash rather than reinvesting them. I think that's where the line's going to be. It does vary so much across the economy as to how people are placed with the cost of living. But more thought, I think, is going to be given to the fact that take some of it out in cash in fairly difficult times that we're in.
In terms of the major players as well, who are they and who's going to be paying out the most?
Well, BHP is going to be the number one dividend payer. $5.6 billion is going to be paid out to shareholders. Then you've got Commonwealth Bank at $3.6 billion. But something like 4 out of the top 5 positions are taken by mining or energy stocks. But it is quite a diverse list.
Now, those BHP payments are down on what they were previously, and so too are the payments overall. What can you kind of tell us in terms of how that speaks to the performance of the market and the performance of those companies?
Well, what we have seen is expenses for companies, costs are rising at a faster pace than revenue. That's cut into profits and cut into cash holdings. It means that companies have had to make harder decisions about whether to pay out the similar level of dividends or cut back in certain ways. But it speaks volumes to the challenging conditions that we've been in.
Now, there was some mention in your note about the competition dynamic and how that's feeding into higher payouts. Can you explain that a little bit further?
Well, certainly, sort of what the individual companies would like to see is their shareholders remaining with them. But if you're not paying out the dividends, then those shareholders may sort of look elsewhere. So we are in times when you get good returns on property, you're getting a decent return on money in the bank, and then you have to look at so the shareholder dividends. So there is a bit more competition for funds out there, given that interest rates have risen and cash. Bonds, property, sort of all paying sort of fairly useful returns.
What then is the future of dividends looking like, and what should investors expect?
Well, investors should expect what's right for the company. It may not be the case of paying out in terms of dividends. It may be going down the route of buybacks to be able to support the share price. It may also be the case that individual company sort of needs to put more money back into the firm. Either buying new equipment, buying new buildings, so the like. And there's also the small matter of wages. Companies sort of having to secure the best employment at the moment, and that employment or those extra people may cost a little bit more in terms of wages.
That's Craig James there from CommSec. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.